Hi guys, this is Rahul from Finance Excel, right? So today I just wanted to uh, have a short discussion on various inventory valuation methods, right? Right. So we are going to discuss LIFO, FIFO, right, and the weighted average cost method, right? So first, let us take an idea of evaluation method and whether it is permitted in the US GAAP or IFRS, right? So, valuation method, US GAAP, IFRS, right? So, LIFO is not permitted in IFRS, it is only permitted in US GAAP. FIFO is permitted under both US GAAP and IFRS. And weighted average cost method is also permitted in US GAAP and IFRS. Right, guys? Okay. So, uh, see, LIFO is not permitted under IFRS, right? Because during period of rising prices of inventory, right? LIFO would result in lower GP, lower gross profit, right? Which would subsequently result in income tax benefits, right? Okay, so now let us have an idea of how LIFO, FIFO and weighted average method of inventory valuation will impact COGS, gross profit, current ratio and various other line items, right? Various other P&L and balance sheet items, right? So, so first we discuss LIFO, right? Okay, so let me erase this once. During period of rising prices, right? How would LIFO, FIFO, and weighted average cost impact various line items of our P&L and balance sheet, right? And also our various ratios, right? So LIFO, right? Again, it is permitted under US GAAP, okay? And what is the assumption of LIFO, guys? Assumption of LIFO is last in, first out. What does that mean? So that means that the cost of the most recent purchase is allocated to COGS or allocated to cost of goods sold, right? And the earliest purchases become a part of inventory, become a part of inventory. So See, because prices are rising here, the most recent purchase would come at a higher cost. Since the most recent purchase would come at a higher cost and they would be allocated to COGS, right? Under LIFO during period of rising prices, COGS would be higher, right? If COGS would be higher, guys, then my gross profit would be lower, my net income would be lower, right? Since my net income would be lower, my taxes would be lower. Since I have to pay out less taxes, my cash balance would be high, right? Since my net income would be lower, my retained earnings would be lower, right? And what would be the impact to inventory turnover ratio? Guys, do we know what is inventory turnover ratio, please? Okay, so inventory turnover ratio is COGS by average inventory. As in this particular ratio, my COGS would be higher and my average inventory would be lower, since the numerator would be higher and the denominator would be lower. The entire ratio would be higher, right? So during period of rising prices, LIFO would give a higher inventory turnover ratio. Now, what I'm talking here is in comparison to FIFO and weighted average cost. So, COGS is higher compared to the COGS under FIFO compared to the COGS under weighted average method, right? So, we are comparing, right? So, COGS would be higher with respect to the COGS under FIFO and the COGS under weighted average method. So, higher inventory turnover ratio under FIFO. Okay, guys, now since the earliest purchases become a part of inventory, right? And during a period of rising prices, the earliest purchases would come at a lower cost, right? So lower cost would be allocated to inventory. So my reported inventory would be lower, right? Inventory that would be reported is lower. That is why I said that under LIFO compared to FIFO and compared to weighted average method, inventory would be lower, right? So since inventory would be lower, guys, my current assets would be lower compared to FIFO and LIFO. Current assets under LIFO during period of rising prices would be lower, right? Since current assets would be lower, right, my working capital would be lower, because working capital is what? Current assets minus current liabilities. So my working capital will also be lower. And what about my current ratio? Current ratio is what? CA by CL. Since CA will be lower, right, this entire current ratio would be lower. Since my numerator is lower, right, the current ratio would be lower, right? Guys, will there be any impact on quick ratio? See, there won't be any impact on quick ratio because quick ratio excludes inventory while calculating the numerator. So quick ratio is basically current assets minus inventory by CL. Right. Okay. Now, guys, I hope this is clear to you. Now we move to FIFO method, right? We move to FIFO method, first in, first out, right? It is permitted under both US GAAP and IFRS, right? The assumption of FIFO is, right, the cost of the earliest purchase is allocated to cost of the most earliest purchases. eh, Cost of the most earliest purchase is allocated to COGS, right? And the cost of most recent purchase is allocated to inventory. Okay, so now impact to various income statement and balance sheet items, right? The impact of using FIFO during period of rising prices on balance sheet and P&L items, right? So guys, the cost of the earliest purchase is allocated to COGS, right? So during period of rising prices, please remember that the cost of the earliest purchase would be lower than the cost of the recent purchase since prices are rising. So COGS would be lower. Since COGS would be lower, GP would be higher, net income would be higher, right? Since net income would be higher, taxes would be higher. Since taxes would be higher, my cash balance would be lower, right? Since net income would be higher, retained earnings would be higher, right? And what about inventory turnover? Now again, I'll repeat at the risk of repeating the obvious. Uh, since See, at the risk of repeating the obvious, guys, we are talking of a lower COGS under FIFO compared to COGS under other inventory valuation methods like LIFO and weighted average method. So inventory turnover is COGS by average inventory, right? COGS by average inventory, right? So under FIFO during period of rising prices, COGS would be lower, average inventory would be higher, the numerator is higher, numerator is COGS would be lower, average inventory would be higher. So since the numerator would be lower and the average inventory higher, the ratio would be lower. So please remember this: inventory turnover under FIFO, again compared to other inventory valuation methods, inventory turnover under FIFO compared to other inventory valuation methods would be during period of rising prices, right guys? Now the cost of the most recent purchase is allocated to inventory, right? So during a period of rising prices, the most recent purchase would come at a higher cost, right? So my inventory would be higher, right? So since inventory would be higher, current assets would be higher, working capital would be higher because working capital is current assets minus current liability. Current ratio would be CA by CL. So since my current assets are higher, right, my current ratio would be higher. Since the numerator is higher, the entire ratio would be higher, right? And there would be no impact on quick ratio because quick ratio excludes inventory while calculating, right? We exclude inventory while calculating the quick ratio, right? Because inventory is the least liquid current asset, right? So this was with respect to FIFO, right? Weighted average method allowed under GAAP and IFRS, right? So we'll be discussing these three methods, right? The assumption is weighted average cost of all goods available for sale, right? Guys, COGS under COGS under weighted average method, right, would be in the middle of LIFO and FIFO, right? So again, I'll summarize this during period of rising prices of inventory. When we speak of rising prices, we mean rising prices of inventory or the price of the product in which we are dealing, right? The price of the product in which the company is dealing, right? So during period of rising prices, right, LIFO COGS. Okay, guys, there is some issue with the OneNote. Just a second, I'll just rectify that. Okay, so LIFO COGS would be the highest. I'll have to just square this up. Okay, just a second, guys. FIFO. Okay, so there is some technical issue. Just wait. So I have to restart OneNote. Okay, so let me erase this for the time being. So erasing this. Right. Okay, so we are good to start. So LIFO COGS would be the highest, right? And FIFO COGS would be the lowest. And WCAC COGS would be in the middle. Right, guys? And similar treatment would be for inventory. Inventory will be in the middle of, right, of LIFO and FIFO. Okay. And guys, when prices are stable and do not change, right, when prices are stable and do not change, all three assumptions all three assumptions will give the same value of all three assumptions will give the same value of COGS and inventory, right? Okay, and guys, during period of falling prices, the relationship would be exactly the opposite, right? So there's no point repeating them. So I hope you are satisfied with this short video. I'll come up with other important points with respect to inventory valuation, right, which is a part of our FRA syllabus, right, guys? So I'll call it a day now. Bye bye.